Hey, this is Pablo, and this is my presentation on investing in the stock market from scratch by Abundancia Mindset. A quick disclaimer, I'm not a certified or planner advisor. Pause this video if you like, but basically I'm not liable for any of the financial advising, as I am not a financial advisor or a CPA, and this is mainly for entertainment purposes. And the expectation from you is that after you're done with this class, you're going to do your due diligence and invest in the things that you want to invest in based on your own research. So a little bit about myself. I'm a IT cybersecurity professional. I've been doing this for about 14 years now. I love traveling, I love eating, and I've been able to visit more than 20 countries and across 5 continents. Part of that is because the investing and also increasing in salary or negotiation, and I'm very passionate about personal finance. This all started around during the COVID times because I had family members and friends that were struggling due to the pandemic. But a lot of that, the root cause was because there was no financial literacy. And so that motivated me to start a blog and start writing about this. So a little bit about me, my investment journey. Like many of us, unfortunately, I was part of the credit card debt. And that all started when I was in college, since I had to get a loan and just like everyone else have to pay it back. In 2018, I got out of debt. I was able to go to also grad school. So I got my master's as well. And really wasn't until 2019 that I actually had some money that I could actually start investing, right? And then a year later, once the pandemic started, I created Abundancia Mindset, like I said, to educate family and friends and just anyone in the internet. I'd also translate it in Spanish to also provide that information in Spanish. As I started, I got really into the personal finance space, started reading books and all that good stuff. And I started Airbnb, and now I'm expanding to a second Airbnb. And my personal goal is to hit a 6-figure net worth. So before we get started here, want to make sure that you're doing your own due diligence, of course, but also make sure that if you can get out of debt, pay off those credit cards, try to increase your income, right? And make sure you set up an emergency fund anywhere from 3 to 6 to 1 year, 3 to 6 months or 1 year. And at this point, you can start investing, right? And later on, you can diversify or optimize, but this is just a quick advice from me. So let's get started. So what are stocks? So think of stock as a company as a piece, as a big pie, right? And you own a piece of the pie. So basically you have some ownership of that corporation, right? So if when McDonald's became public, investors were able to invest in it, right? Now I have access to that stock and I'm a shareholder, right? So this, again, you're just claiming some ownership of the company, even if it's just a small portion, but you are part of that. And as a shareholder, you also have a say in the company, right? Maybe what typically happens is a company would appoint a board of directors. So you have an actual representative, right? Just like you have in a government, you have representatives that speak on your behalf as a shareholder. But in general, you have access to things like dividends, which I'll touch later, but just very simple. You're able to buy and trade via the stock market, and I'll touch a little bit here in a minute, but this is basically what summarizes the stocks. So why do companies issue stocks, right? So a lot of companies start issuing stocks at a point where they're trying to grow the actual company, right? So think of a local bookstore, right? Let's use Amazon as an example. Started as a small bookstore. Later on, as it started generating profit, you want to grow the company, right? And then you make it public by offering initial public offering, right? So at this point, the company becomes from private to public, right? And now this attracts a lot of investors. And if the company If the investor understands what the company's about, right, their mission, they might, and if that aligns with what they want to invest in, then they can put their money in there, right? And now the company grows, right? And like I mentioned, typically these are purchased via the stock exchanges. The New York Stock Exchange is probably the most popular here in the US, and the NASDAQ as well. So for you, why should you buy stocks, right? Like I mentioned, you can help grow companies, right? So if you find a company that you feel aligns with your values, or maybe that's where you feel the future is going, right, and that company is doing work there, maybe you want to contribute that, right? Whether that's environmental or maybe electric vehicles and whatnot, that's one reason. Second is you're probably already a customer, right? So think of the things that you're wearing, right? Your shoes, what kind of car do you drive, what kind of streaming services do you watch, right? So most of them are companies, and most of them are publicly traded, right? So if you're already using their products and you know that there's customers like you, right, and the company might do well, why not invest in them, right? Third one is that you can grow your own investments. So as an individual, a stock is an asset, right? And an asset, just like a house, it appreciates, right? So understanding that the stocks are assets that you can invest and then they can gain value, then, well, it only makes sense to invest in them, so that way your money can grow with those assets, right? And the fourth reason might be that some of these companies provide dividends, right? So a company share has dividends, which is basically part of their revenue. They might give you a small percentage to shareholders, which is you, maybe every quarter or every year, as long as you have your stocks invested in there. And I'll touch on a little bit here next. Let's take it back a little bit and let's talk about the stock market history, right? This all started very early on in Europe and in other countries, right? So I'll give you a second to look at this, but honestly, what we're interested in is in the stocks, the New York Stock Exchange, which started in 1792, and then later on the NASDAQ also, which these are two of the primary stock exchanges here in the United States. And a little bit of stock market history. As you can see, there's a bear and a bull, right? You probably heard of bear and bullish markets, but basically since the 1920s, right, as you can see, the stock market has gone up and down and declined, right, over time. And this is basically because an imbalance in supply and demand, right? Sometimes you have a lot of people buying, sometimes you have a lot of people selling because of fear or greed, right? It boils down to those two things. But the whole takeaway from here is that historically there's been positive returns, right? So investing in the overall stock market has yielded anywhere from 10 to 12% or 10% since 1957. So looking at historical data, this is a good sign, right? And the point of this that I'm trying to make earlier is just think long term, right? Stock market is also crash, right? And there's been several crashes, and there will be future crashes as well. So earlier on, because of the Great Depression, we have the stock market crash. 1987, the Dow Jones drops more than 22%. There's time differences in the computer systems between here and Europe, creates Black Monday. The early 2000s, dot-com bubble. So you have all these speculations, all these companies that are supposed to be the next big thing, right? Like think of Yahoo, think of AOL, and a lot of companies. So there's a lot of speculation over value, and that doesn't work out the way it was, right? 2008 financial crisis, banks are lending way too much money to people that can't afford, $400,000 home, and that creates a financial crisis. And then the pandemic that we're still currently going through, COVID-19. So point of this is just to show you that there's going to be events that are going to happen in the future, but as you saw in the previous slide, there's always typically a positive return, right? So just keep that in mind. Again, like I said, there's always bull and bear markets, right? So bull market is when the economy is doing really well, right? and things are favorable, so the stock market is going up, right? A bear market is the opposite, right? Economy is receding and most stocks are going down in value, right? So here's where we stop. Quick review. Number one, if you want to pause it, at this point you understand what stocks are, right? And you as a shareholder have the rights to that company, that entity. You understand the basic history of the stock market. You understand that long term there's positive returns, but there's always going to be dips, right? The stock market is going to go down. You understand some of the terminology like bear and bull market, and you understand that the stock market again is going to go up and down. So let's touch a little bit on the investment mentality, right? So successful investors, which is going to be you, control their emotions, right? Imagine when a person buys a Tesla at $800 because they get in, they saw news headlines, etc., right? But 3 months from now, something happens. Tesla didn't meet their profit for that particular quarter. Investors freak out. They start selling. Now your $800 stock dropped to $500, right? A lot of people would get freaked out and they would start selling, right? So they would set a loss, and these individuals might say that, okay, the stock market is a scam, right? Or is a gambling, right? So unfortunately, it has nothing to do with that. It's just because that investor wasn't well prepared and they're relying on their emotions to invest, which is not a good thing. Number two, like I said, you saw that typically if you invest in the S&P 500, which are the top 500 companies in the New York Stock Exchange, typically you're going to get a return of over 10%, right? So again, I'm trying to push the idea or the agenda that buying and holding long term is probably the best idea, especially if you're a new investor. And like I said, when things go down, right? When the market's down, this is actually the best time to buy, because think of it as, maybe in the holidays, you get discounts, right? And people love buying at discounts. So why not apply that same logic to stocks, right? And again, as a reminder, number 4, everything is based on supply of demand, right? So, all right. Now, here's some of the investment strategies that you could take regarding stocks, right? Again, a stock, think of a stock as a, physical asset like land or a house, right? It's basically the same thing. And just like those assets, the stock appreciates, right? So for example, if you bought Apple stock at $99 2 years ago, right? And now it's worth $400, well, that asset has appreciated, right? And that applies to other things, real estate, mutual funds, ETFs, which I'll touch on later. And that's one sort of strategy. The other one is dividend payment, right? So I touched earlier on dividends. So dividends is the distribution of corporate profit to eligible shareholders, right? So think of it like this. Let's say if a company declares $1 share dividend and you own 100 shares, then you would get $100 just for keeping your money in that company, right? In future slides, I'll touch on some companies that actually give dividends, right? And then some that do not give dividends, right? So not all companies give out dividends. So stock trading versus investing. You might hear those two terms interchangeably, but there is some differences. So for trading, think of the folks sitting in the floor on the New York Stock Exchange, the people that are yelling, and all your typical Hollywood type of scenes, right? But there are various ways, right? Basically, typically when you think of trading is short term, right? Some people might do it within a few hours, a few minutes, a few days, right? And one of the things that we'll touch later on is swing trading, right? So the basic understanding between trading and investing is that trading is short term and investing is long term, right? Trading is actively managed, so you have to be on top of understanding about the company news, how we're doing, right? Buying stock short term, you're focusing only on share prices, right? You don't really care whether long term things. You want to make quick gains, right? Maybe this morning you got a stock at $10. Tomorrow that stock is at 30 and you decide to sell right away, and there's obviously tax implications there. But again, also high risk. And now with investing is more passively managed. Investing is long term, so it's definitely not exciting or nothing to brag about. But you understand that this is very low risk, and at the end of the day, you're almost always guaranteed that you're going to get a return, long term, even if it's long term 10 years from now, but you're going to get this return of at least 10%. So which one should you do, right? Should you trade or should you invest long term? Well, you can do both if you like. Like I said, if you're a beginner, if you're just getting started, the investing route would probably be much more favorable. But as you get more comfortable, as you go through this course and do your own education, you probably get more comfortable trading. And now, where can we actually buy the stocks, right? So now we touched on why should we buy stocks. Now I'm convinced, right? So let's get started. You can buy and sell a variety of investments such as stocks, bonds, and mutual funds, or ETFs via Brokerage Account, right? So some of the brokerage accounts are some of the ones that you see here, like Charles Schwab, Fidelity, Vanguard, TD Ameritrade, E-Trade, Robinhood, which I'm personally not a fan of. But anyways, you might be familiar with some of those companies because your 401k might be enrolled in those companies, right? So you're currently working and you're currently contributing to your 401k, which is going to one of these companies, most likely. And that's a retirement account, right? So you have to open a brokerage account to be able to buy individual stocks or ETFs or index funds, which I'll touch on later. Some of the requirements for this one is typically social security number, tax identification. You need to provide some information, just how much money do you make, that sort of thing. And some of the things to watch out for is any kind of fees, right? Most places nowadays are very low fees. They don't really require you to do much, but if you have mutual funds in some of these organizations, you might want to talk to your financial advisor and make sure that you're getting lowest cost, right? So now moving on, here's an example of a Apple stock, right? So if you were to Google Apple, this is probably not today, this is from a few days ago, but it's gonna look something like this, right? So you have your time chart here, which you can do, 1 day, 5 days, 1 year, 5 years, or max, right? And that can give you an idea of how the stock has been moving, right? And later on, we'll talk about trend lines, but for now, this is a simple stock, right? Remember, the stock market is closed from 9:30 a.m. to 4 p.m. Eastern time. So if I work 8 to 5 p.m. here in Houston Central Standard Time or in Chicago, well, unfortunately, I wouldn't be able to trade during the day, right? So there's only a market time. The open is the open price. So at 9:30 a.m., the stock, let's say, is 160. Close price, the price might be 161 because the stock went up during that day. The high is the stock highest price for the day. The low is pretty low. The market cap value is basically the total value of company share, right? And you're gonna hear things like PE ratio, which is the price earnings ratio, the dividend yield, the percentage of the company share price that it pays on dividends, right? And like I said, not all companies will pay dividends, right? And you have things like the 52-week high and low. That's just telling you the last year what has been the highest and the lowest. And that's just going to give you an idea of where the currently, where the stock price currently hits. Like I said, you can look at it in multiple ways: 5 years, 1 month, 1 year, 5 years. And here, when you start looking long term, you can get an idea that, hey, if you, just like everyone tells us, right, if we had invested early on, we would have gotten big gains, right? But this again proves the idea that sometimes buying and holding might be the best option, especially if you're just getting started. And again, you just have to be patient and be consistent investing in these things, right? So what are some factors that move the stock market? So sometimes you might see that the stock goes up, it goes down, right? And it's difficult to understand sometimes, right? So here's some of the factors that typically happen, right? And remember, it's all based on supply and demand, right? So when the buy orders outnumber sell orders, usually the price declines, right? And when the orders outnumber the buy numbers, typically goes up. And here's some of the demand. The demand is actually proportional to 4 factors: earnings, the economy, the expectations, and emotions. So let's touch on those real quick. So let's say Apple was going to release a new iPhone, right? And they were delayed, maybe there were manufacturing issues, etc., or the iPhone started catching on fire, right? So if the company didn't hit their profits for that year, right, well, investors are gonna feel negative about it, right? So why should I have my money in stock in Apple when I could have been investing in Tesla, right? So maybe I'm gonna sell my stocks and buy more of Tesla because I feel like Tesla is doing a better job, right? So some of those the pros, and at that point, if once a lot of investors start selling, well, the price is going to start declining. So that impacts the stock price, right? The economy as well, macroeconomy. So think of interest rate, inflation, unemployment. Think of COVID in March 2020 when most companies just went down, right? And obviously that had nothing to do with the companies at the time, right? That's just the overall economy. Also the expectations, like I mentioned earlier, if I'm an investor, I have certain expectations of a company. Make sure that management is running the company efficiently and utilizing my money in such a way that it can have the best returns, right? And if they're not meeting those expectations, then I want to take my money out and put it somewhere else, right? And also, like I mentioned, the emotions, right? So people get too greedy or they start getting fearful and selling. So those are some of the factors that contribute to the overall stock price. Now, think of a company, right? So in this example, we use Apple, right? You can look at the company's overall health just by looking at their financial statements, right? So typically there's 4 sections like the balance sheet, income statement, cash flow, and the explanatory notes. Most of those are included in a report called a 10K, which is basically a report that's provided by each company to the U.S. Securities and Exchange Commission, the SEC, right? And that's going to give you as an investor an idea of how well the company is doing, their balance sheet. So how much debt do they have, right? Do they seem like they're pretty healthy to continue growing, right? And a lot of times you're going to get an idea of what the company's actually about, which I'll touch on a little bit later, more advanced. But let's say you wanted to see how Apple's doing and maybe you have a few stocks there, right? This is where you go. Most companies will allow you to access the quarterly earnings. Quarterly earnings call typically happens every 4 months, and you as an investor typically get an invitation, and it's typically you dial a number or a Zoom session, right? And you listen and see what typically the CEO has to say, or the CFO, the financial officer, and typically they update on how the company is doing, right, or which direction they're doing. Maybe there's mergers, etc. And you as a stock holder or the shareholder have access to this that the public does not have, right? But in general, most publicly traded companies will publish this report. And within Apple, you can browse to investors, look at the quarterly earnings report, and then take a look at those documents, right? And again, this is mainly doing your due diligence and making sure that company that you're investing is healthy and is going to continue growing. So, quick review number 2. We touched on the investing mentality, right? How people feel, they speculate, they get fearful, they get greedy. Some of the investment strategies, right? Whether capital appreciation or whether it's dividend based, trading versus investing, and how to look at the company's health report. I'm going to touch a little bit on taxes here, just because before we actually show you how to start investing, consider, remember that anything that generates income is going to be taxed, right? Uncle Sam and the IRS are not very friendly. So make sure that if you start investing, you understand that there's 2 types of capital gain taxes, right? One of them short term. So when I say short term, I typically mean anything less than a year, right? And if you buy, especially later on as you get better at investing or trading, and you start doing things like swing trading, which is very short-term trades. Make sure that you understand that there's going to be tax implications, right? And a lot of that is based on where you're at with your tax bracket, right? So if you make anywhere from 86,000 to this, there's 24%. Obviously, it's a little bit different. This is if you're filing single, but if you're married, there's a little bit slightly different tax brackets. And again, long-term capital gains might be anywhere from 0, 15 to 20%, also depending on your taxable income. And again, my advice is just hold long-term, at least more than 365 days. And that way, at that point, you can sell if you like, and you're not going to take as big of a tax hit. More on dividends. So at this point, we touched on dividends, but here's a quick refresher, right? So it's the distribution of the company's earnings via dividends, right? And the price is determined by the board of directors. And one year you might have a pretty good dividend yield, but the next one you might not. So keep that in mind. But if you're interested in just getting money from the companies that you're investing in, right? Well, first find a dividend paying stock, right? And compare it to other peer companies, right? So if you're looking at Chevron, maybe look at things like Shell or ExxonMobil and other companies, right, that give dividends, and see which one makes a lot more sense for you. And determine how much money you want to invest. Some companies are going to yield over 4%, right? Like here are the top high dividend stocks for 2022. And keep that in mind. This is just a screenshot. You do your own research. So here's some of them, right? Like Phillips 66, Lino Basel, petrochemical companies. Most of those are petrochemical companies or insurance companies. When it's high, you want to make sure that we go through those financial reports that I touched earlier, and making sure that you do your due diligence. That way you don't have any negative surprises, right? So most dividend paying companies are companies that are already established, right? So think of Johnson & Johnson, think of Ford, think of all these companies that are established. Maybe they're not growing a lot, but they're going to be around, right? So some of them include, oil and gas, banks, financial, basic materials, healthcare, pharmaceutical, etc. And there's something called the Dividend Aristocrat list. So these are companies that have been given dividends in over 25 years, right? So there's a high possibility that those companies are going to remain giving you dividends. So if you want to look for them, just Google Dividend Aristocrat list. Another good way to invest is in real estate investment trust, or REITs. So I touched on stocks, right? Right now, the presentation's on stocks, but there's other things that you can invest on, like bonds. So bonds, real quick, they're basically loans, right? So you're giving a note to the government and you're letting them borrow money. They're going to invest it, and in 10 years, they're going to give you your money plus 10% interest, right? That's a different story, but REITs allows you to invest in real estate, right? So let's say you're interested in real estate, but you don't want to own any physical land, or you don't want to deal with tenants, right? But you still want to invest in real estate. Well, this is a good option to do that. And basically, just looking at this graph here, right? You and a group of investors invest in a REIT, and this company uses the money to buy and manage real estate, right? So think of offices, skyscrapers, right? Think of warehouses, think of the mall, think of housing, right? Apartments. Then, they're going to pay rent, they're going to provide, so it's going to generate some profit, and up to 90% of those profits are going to be returned as dividends to the investor, which is you, right? So if I have $100, I decide to put it in a REIT, right? Those $100 are still going to be there, but then over time, I'm going to get paid, let's say a few dollars based on those $100, and just for leaving my money there, right? Again, this is not a stock, so those $100 might not increase. And again, if the company, or let's say we have COVID, something like that happens, and it impacts the real estate market, I might not get in the returns that I was expecting, right? But I'm not gonna lose that money, and 5 years from now, as I'm getting free money every quarter or every year, I can always withdraw my $100, right? So anyways, here's like I mentioned, right? You pay rent. Other stores or businesses also are paying rent to someone, right? And that someone is a corporation, and they typically have a REIT available. So you can visit more if you go to REIT.com. It'll show you some REITs out there that you can invest in. And this is the conclusion of part 1. So now you're done with this part of the course, right? Now you understand why you should be investing in the stock market, and historically the S&P 500, how it generates positive returns, right? Now you understand, basic idea of looking at the company's health, and also some of the factors that impact the company's stock, which is earnings, economy, expectations, and investor emotions. So now it's actually a good time to pause, and if you want to go back and sort of do a little review, feel free. But now we're going to move on to the actual hands-on. So first things first, you want to open a brokerage account, right? So like I mentioned earlier, you saw some of the brokerage companies there. Again, some of those you're familiar with because of your retirement account for your 401k. So if that's easier for you, just go to your company, right, and open a brokerage account, right? So a brokerage account is going to allow you to buy individual stocks or ETFs or invest in index funds, right? Typically, your retirement account is usually just for your 401k or other IRAs like a Roth IRA. Again, if you need assistance, you can YouTube any of this, right? So YouTube, how do I open a brokerage account with Fidelity? How do I open a brokerage account with Vanguard, right? And if this is too much for you and you just want to get started, then I would recommend just open a TD Ameritrade account, right? And I'll go through that in a second. But also, here's some, I'm comparing Fidelity, Vanguard, Charles Schwab, which are one of the well-known ones. And most of them are the same, right? So they're going to allow you to invest in stocks, options, ETFs, or mutual funds. Again, you have access to those Roth IRAs. There's very little differences, honestly, in most of them, especially except with Vanguard. When you start investing in mutual funds or index funds, some of those have a minimum of 3,000, but not all of them do. And anyways, just giving you a quick example here. But let's say if you wanted to look at how to get started here, you can go to Ameritrade, right? If you go there, open new account. You want to open an individual account, go through this, fill it out. And once you get there, basically you have access to buying stocks, right? I personally use Vanguard and also have Fidelity, and I've also used Charles Schwab. So like I said, you can't go wrong. But in terms of simplicity or just getting started, I think Ameritrade is a good option. So you can't go wrong. And once you do that, well, now we're ready. So let's keep going. So as a reminder, I'm always going to remind you to control your emotions, right? Don't get too greedy and don't get too fearful. Remember, when the stock market drops, it's actually a good thing for us, right? Because you're better prepared compared to most investors. While they're going to be selling their stock, you're going to be buying, because you're going to be buying at a discount, which is really amazing. So now, I talked a lot about investing, right? But how am I going to actually invest in, right? So look at this picture. The first two options here, it's super simple, right? I just want to get started. I have some money, but I don't really want to spend much time doing anything, research. I just usually go to work. I have some savings, but I want to start investing, right? So these two options are going to be better for that. And options 3 and 4, it's going to be more, okay, I want to understand more the stocks, and I want to invest in growth stocks, companies like Tesla or PayPal or Shopify, whatnot, right? So just a quick summary of that, right? So we're gonna go through each one of them in the next few slides. So first one, right? We're gonna keep it simple. We're gonna invest in things that we already own, right? So think of the things that you're wearing, the streaming service that you're using, the car that you drive, brands, etc., right? Second one, we're gonna invest in ETFs and index funds, right? So basically, we're investing in low-cost baskets of portions of stock, right? We're not investing in individual stock. We're investing in portions of stock that are part of a basket, and we'll touch on that later. Number three is investing in growth stocks, right? So we're going to do a little more research on actual companies, and we're going to identify which ones are good to invest in and that are going to probably provide us with the best returns. And then number four, we're going to invest in companies that we do our due diligence and look at a technical report and read the stock charts to identify which ones are going to be the best for better returns, right? So let's get started. Here's a quick sort of summary, right, of those options that I just touched on, right? Some of them, when I say time returns, I just mean, it's best to leave it, buy it, and hold long term, right? The difficulty is how easy it is to get started and how easy it is to research this information. And then the risk is the risk of, is there a high likelihood that I'm gonna lose money or not, right? So you can see very low. We started from low to medium and more difficult. So, all right, option number one. Let's keep it simple. So here, I want to make sure that, like I said, take 45 minutes and think about the items, the material items that you own, the places that you frequent, right? Or the streaming services that you look at, right? Now write down each of those products, right? So for me, I wrote down an iPhone, iPad, etc., right? Then I identify the companies that these products belong to, right? So those belong to Apple, right? My computer has a graphics card for videos, etc., and that comes from NVIDIA, right? I have other devices that belong to Samsung, right? So whenever you find those items and then you're ready to look at the companies that those items belong to, or that manufactures them, look at the stock ticker, right? The stock ticker symbol is the symbol. Like, for example, Nike is NKE, TJ Maxx and those stores, Marshalls, fall under TJX. So that's just going to give you a quick idea on how to actually find them, right? Now, again, do those and then breaking down into different categories. I think it's going to make it easier, right? Also, for a lot of those, right, like if you drink Nescafe or Hot Pockets or Kit Kats, a lot of those products actually belong to parent companies, right? So in this example, Nestle is NSRGY, right? So take some time to list those out. And again, there's more, right? Think of your healthcare provider. I have Aetna, right? Real estate, where do you live? Who actually owns the parent company, right? Or what services do you use for streaming, right? Or even you use Microsoft Word, etc., right? This is going to be a super simple, quick way for you to identify companies that you can invest in, right? So now, once you've identified that, maybe pick 3 to 5 categories that you're interested, right? And this is going to allow you to diversify. So again, I'm always going to remind you 2 things, right? 1, buy and hold long term, and 2, diversify, right? And what I mean by that is, think of when the pandemic started, right? So a lot of companies, especially real estate or the airline industry, those crash, right? But companies, technology companies, or things like Uber Eats or delivery services, those companies shot up in value, right? Because people were using those a lot, right? So anyways, think about that for a minute. 3 to 5 categories, a few companies, and then determine how much you want to spend, right? So if you have $500, right, here's an example of some stocks. Well, maybe you can only afford 12 Academy stocks, or maybe just 2 Apple stocks, right? Or just 1 Home Depot stock, right? But like I said, once figure out how much you want to invest and invest consistently, right? If you're gonna do this, my recommendation is buy it every month, make it part of your spending, right? Of your budget. Include $100 to invest or whatnot. And also keep in mind, invest long term, right? Here's a quick screenshot of Home Depot, but you could basically look at most companies, right? That Academy Sports and Outdoors, obviously Zoom, or a few companies like that. If you look at the past 5 years, well, they started very low, right? So let's pretend that you invested in Home Depot, you invested $10,000, right? Well, in the last 5 years, you would have made over 30 or close to $40,000, right? So that's just by investing and leaving it there, right? So just something to think about. All right, now we're moving on to our second investment options, which is ETFs and index funds. Again, reminder, control your emotions. All right, so ETFs and index funds. So what are they, right? So think of them as baskets of securities, which is, like I said, stocks, bonds, options. The trade in the exchange, right, in the New York Stock Exchange, just like stocks would do. You have some that are US based and some are international, right? So keep in mind diversification. Not only invest local, but also invest international, because you have access to the whole world market. Here's some well-known ETFs. Invesco QQQ is one that I personally invest in, and it relies heavily on technology companies. Index fund is basically very similarly as well. The only difference, obviously, their ticker symbol is different, right? And there are some differences here, right? So how are they similar? Well, they're both bundled together. They're both baskets of individual, basically partial, stocks, right? So you're not investing in individual stocks, but you're investing sort of in a partial share, right? If that makes sense. They're low cost and they're passively managed, meaning that, like I said, this is super easy. Just invest and forget it, right? And typically they provide you with long-term results, which I'll show you here in the next slides. Now, the only difference really is that ETFs, you can buy them throughout the day, just like a stock. And the index fund, you have to buy basically at the end of day. So the end price, right? And typically ETFs have minimum investment, right? So an ETF might be $300, while a Vanguard, S&P 500 index fund might be a minimum of $3,000 to invest in, right? And the capital gains are a little bit more flexible, more efficient for ETFs than index funds, but both of them are really great options, right? And don't think too much about it, just do it, right? So when it comes to ETFs or index funds, these are based on sectors, right? So in the stock market in general, there's 11 sectors: energy, materials, industrial, healthcare, etc. Just like they're shown here. So let's think of something like consumer cyclical, right? Consumer cyclicals are companies that, like I said, it's not something that's it's not a staple, it's not a necessity, right? But it's things that include luxury items, airlines, furniture, cars, etc. And some of the companies that fall under consumer cyclicals are Home Depot, Lowe's, Boeing, or Nike, right? So like I said, just like how you did in the other category that we touched on individual stocks, this one is basically the same, but it's not categories, it's sectors. So do the same, rinse and repeat, right? So for this one, list out the sectors that you're interested in, right? And then find some ETFs that are associated with it. Like I said, always look at the historical trends. That way you can get an idea if this stock or this ETF or index fund is going to go up, right? Which most of them do. Like I said, most of them are already low cost. So the only thing you have to worry about is really discipline yourself to invest every month or so, right? So here's some sectors. Here's some ETFs, the equivalent of ETFs, right? And equivalent index fund, right? So maybe you want to show real quick. So let's say technology ETFs. And then you're gonna get a few list of ETFs, right? And you're gonna get an idea of where do they belong to, and also how much do they have, right? They're in their total volume, the total assets, etc. Right? So it's just gonna give you an idea of that research process that you have to do. All right. Again, always keep in mind, diversify. This is the example I gave you earlier, right? During the pandemic, Zoom, Grubhub, Uber Eats, that shot up way up, right? While a lot of other companies, including real estate sectors, were going down, right? So always keep that in mind. Diversify so that way you make money when the economy goes up and it goes down. All right. So like I said, here's an example of QQQ, which heavily relies on technology, right? So this one's made up almost of half of it is made up of technology. The rest of them is communication services. So think of internet service providers, right? Like AT&T, Comcast, Xfinity, that sort of thing. Consumer cyclicals, the ones that we saw as well, right? Financial services, etc. And when we see, these are the companies that this is made out of, right? This is mainly Microsoft, Amazon, Google, etc., or Apple, and that's what makes up this EQQ ETF. And very similarly, this is an index one. This is Vanguard's BTSAX, which tracks the S&P 500. So basically, it tracks the whole market, the top 500 companies in the stock exchange. And as you can see, this one's a lot more diversified, or it actually invests in a lot more sectors because it's tracking the whole market, right? The whole index. So in this one, this is lower, it's about 20, almost 25%, technology, industrials, energy, communications, etc. And these are the companies that make it up, right? So even though this one's not investing so much in technology, you can see that still a large portion of those are technology-based companies, right? And you could debate whether like Apple or Google are technology companies, because some might say that they're also financial companies, right? Because they also provide, credit cards and other things, right? And like I said, they're all made up of the sectors that we touched on earlier, right? So again, do your due diligence, see which one makes sense for you, but don't spend too much time on it. These are things that are supposed to be super easy and simple. So again, buy and hold long term. If we look at that ETFs for the last 5 years, you can see that it's gone quite a bit, right? Same thing for the overall stock market, right? So this is the S&P 500. As you can see, it's given pretty good returns, right? So think about it, right? Buy and hold is basically the key here. So imagine what's going to happen in the next 5, 10, 20 years, right? In 30 years, you could probably pay your house mortgage with this, right? Or you can pay for your kids' college. So keep that in mind. This stuff is very powerful, and all it requires from you is just to start investing, right? So moving on, let's get a little more advanced here. So here, we're gonna look at stocks, but we're gonna look for growth stocks, right? So you're gonna spend some time, however much time you need, to identify companies that are great for opportunities, and we're gonna focus on growth stocks, right? So what are growth stocks? So those are companies that are expected to increase their profit or revenue like much faster than their industry competitors, right? So think companies like Amazon, Uber, Lyft, PayPal, Etsy, Shopify. Those are moving way faster than, let's say, your Boeings or your any other companies in that same space. And they typically have some sort of competitive advantage, right? Like people think of Apple as visionary and they create really amazing products, right? So that's their competitive advantage. Now, the downside to those growth stocks is that typically they're riskier, right? So they invest a lot of money, they hire a lot of talented people, etc. But sometimes if it doesn't work out well, there's a bigger risk. And also a big important message here is that those growth stocks typically don't issue dividends, right? Like we talked about earlier, companies that are well established like Ford and companies that are not going to go away in our lifetimes, at least they typically issue dividends. The growth stocks don't. So while you're looking through this, consider the next big thing, right? So identify macro trends. So macro trends are events or things that are going to happen in the next 5, 10, 30 years, right? So things like, now we're about the blockchain. There's autonomous vehicles, right? There's virtual reality. Think of a lot of companies like Meta, Facebook, they're investing a lot here, right? And automation, datafication, and also consider other factors like I touched on earlier. Always from a diversification point of view, you want to make sure that you also invest in other markets, right? The Western countries are declining, right? The US, Europe, we're declining in population, especially with young people, right? But right now, there's a big boom of young people in Asia and Africa, right? They're starting to work, and there's a lot of opportunities there as well. So make sure that you consider that as well. And some of the characteristics for this growth stocks, right? So for this individual companies, typically is that they have high profit margins, like they're rising profit margins. That's going to allow you to increase. So even today, if you invest in a startup that you really believe and the company is not doing that great, right? Maybe within 2 years, that stock might go from negative to positive real quick, right? And that's part of the growth stock selection. Make sure that they have a strong sales growth, right? So look at, like I showed you earlier, look at the reports, and I'll touch that a little in the next slide here. But make sure that they also have projected growth earnings, right? So for a lot of those, you can go to independent analysts, like for example, earningswhisper.com. This is going to give you when those companies have earnings reports and whatnot. Make sure they have a high return on equity, like I mentioned. Make sure they're using my money in an efficient manner, right? They're not just spending it unwisely. And make sure that they don't have much manageable debt, right? A lot of companies might have high growth, right? But unfortunately, they're investing all their capital in certain places, and now they're gonna become bankrupt if they continue going at that rate. Except now, this is where you have to do your due diligence, right? So like I mentioned before, most companies will provide a section of this in the 10K, right? They're touching on their operations, right? Typically, there's something called the Management Discussion and Analysis, MDA, and this is the one that's filed to the SEC. And this is going to give you an idea of what the business overview is, right? So even if I find a company that I don't know much about, right, I could read this and it's going to give me a business overview, right? Think of an elevator pitch. This is going to give you an idea what the company's about, what do they do, right? What is the management plan? What are the industry trends, and maybe this is going to show me where that competitive advantage is going to be at, right? Now, go through the financial statement analysis, make sure, look at their balance sheet, make sure they don't have enough debt, right? Get access to their presentations, right? For example, Apple has apple.com investors earnings call. If you're already a stockholder, you have access, or maybe the presentations. Once you go through those, right, 1 through 4, now you can start looking at specific industry, right? Find some competitors, right? Find some competitors to Tesla, to Apple, to other companies, right, that you identify, and see what they're doing, right? And maybe another company is doing this better, right? They're industry leaders in that space, or they're doing much better than the company that you're interested in. And also determine the fair value, right? How much is this over speculated, right? Just like cryptocurrencies right now, they get over speculated, but maybe in reality, it's not worth it, right? Because there's really no value in what they're providing, or the service or the problem they're trying to solve. Look at drivers. What are some trends that are happening? And also, look at news articles and determine if there's any factors that get influenced by that, right? Like in the future, there's going to be a lot of our environment. Maybe how do we break down plastic and make it more eco-friendly, that sort of thing. And also just wait for buying opportunities. Like I said, don't get too caught up in emotions, right? And maybe have a set price, right? Maybe I'm investing in PayPal, but I think right now it's too high at 170. Maybe I'm gonna go in there once the stock drops to 160, right? Alrighty, so now we're in the last section, and this is things that maybe you want to pause the video, take a break because this was going to be the more challenging one, right? So last option, investing in individual stocks based on reading charts, right? So in this one, let's say we did our due diligence and we're looking into a growth stock or any other stock, right? But we want to see how good, or if there's any trends that tell us if this company is worth investing, but most importantly, allow us to see when to actually buy, right? A lot of it is people try to time the market. You can never time the market, but understanding stock chart is going to allow you to see when is the best time for you to buy and also when is the best time to sell, right? So that way we're not holding on to something that's going to crash and lose value, right? And a lot of those we're going to analyze them based on the 20-30 day moving average or 30-week moving average. And like I said, we're going to identify when is the most optimal time to buy and sell. And we're going to rely on technical information, not our feelings. So here's a basic introduction to stock charts, right? The ones, if you Google a company, you're going to see something like this. It's great and all, but it doesn't give us a sort of granular view of the stock, right? To identify if there's any trends, right? But looking at stockcharts.com or tradingview.com, I pull up the same one, which is Apple, right? Here, you can see this right here, this moving up and down red. This is called a candle, right? So those candles are basically real-time stock prices, right? And as you can see for Apple right now, the current price is 172, as you can see, right? This blue line here is the moving average, right? So think of moving average. I believe this is in daily or weeks. This is just the average of how this is going, right? The stock. So sometimes, for example, is just average in the last 30 days or the last 30 weeks. And I'll touch that on a little bit, but just wanted to show you how a stock looks like when we're pulling technicals on this. So we have a basic stock, right? There's typically three directions that a price is going to move, right? It's either going to go sideways, up, or sideways, or down, right? So only up, down, and sideways. And typically you have 4 stages of a stock, right? First one is the accumulation area, right? So maybe even if a stock just getting started, right, is going to remain flat for a bit, right? And at some point is going to shoot up, right? Maybe there's mergers, maybe there's good news, etc. And at some point it's going to lose momentum and it's going to get back to sort of a plateau, right? This is the distribution or stage 3. And at some point, maybe there is some bad news or investors start losing interest because it's not moving anywhere, right? So as investors start selling, people panic and is going to drop value, right? And then at some point it's going to go back to stage 1, right? And it might go again, right? So historically, as you can see, that is the trend that we typically see with most stocks. And like I said, here the next one is basically the same chart, but here I'm showing you that 30 moving average, 30-week moving average. We're going to use the 20-day moving average later, but I'll touch on that a little bit next. So when is the best time to buy and then when is the time to sell, right? So the best time is when the whole market is bullish, right? Like I said, when it's the overall market is moving up, right? So we're good, we're healthy there. Making sure that the first stage is breaking into that second stage, right? So the best time to buy here is in this area when stage 1 is about to break into stage 2 here, right? So when it crosses that is the best time. Now, it's not to say that this is the worst time, but once you start buying here, it's already too high. So typically what happens with the media, right? You're looking at Yahoo News or Bloomberg and they're talking about the hot stocks, right? When that happens, usually the stock is already over here, right? So you didn't get a chance to buy it over here where it was cheaper. You actually bought it way over here. And typically that's not the best way, but unfortunately, because we're not informed, this is where we would typically buy, right? And then later, those investors or other people that already have their money there, right? They're really, I mean, in reality, this is manipulating the market. At some point, they're going to start selling, and then people are also going to freak out and they're going to sell at a loss, unfortunately, right? So just quick notes, right? Never sell a stock that is in stage 1 or 2, right? Why? Because if you're selling here, the price is still going up, right? So you're missing on potential money that you could have gotten, right? And also never buy stock in stage 3 or 4, right? Because why? Because it's about to start declining. So if I buy here at $100, well, next week it's a 90, week 80, 70, and I just started losing money, right? So this is the best time to buy. This is the best time to sell. All right, so let's touch on a few definitions here, right? So all this information, I got it from mainly a book by Stan Weinstein, right? So I like to read some technicals, right? But he basically predicted the stock market crash in the 80s, right? And a lot of the fundamentals I'm using here apply to the overall stock market, right? And I find it to be very, very true. And I hope that through this, it's going to allow you to become a better investor and take a look at stock charts, and that way you can invest in them here. So anyways, here's some of the definitions, right? We sort of touch on the basic stock and how it looks like. So this is just an example of one stock. It could be Nike, Apple, etc. So the support line is the area here where stock has been declining and is likely to stabilize. So think of it as a floor, right? So the floor is holding something from moving down, right? So that's the support. The resistance is the supply, where the zone is rallying stocks and is likely to go into trouble and then bounce back, right? So this is a resistance, right? Where this is kind of holding it, right? And at some point it's going to break the resistance zone and it's going to go up, right? The moving average, like I said, this one allows you to kind of see a trend, right? So instead of looking at this, the candlesticks, right? Or these raggedy lines, right? Because the ragged lines is basically the true price of the stock. This one allows you to create a like a trend, right? And it makes you, it allows you to kind of see sort of from a larger view, right? And also 30 moving average, like I said, that could be days or weeks. 30 weeks moving average is going to be best for long-term trades, and 10 weeks moving average is going to be best for short-term. Now you have things like the breakdown and the breakout and breakdown. So the breakout is when the price of the stock moves top of the resistance zone, right? So right here, sorry, breakout. So a stock is down, right? And at some point it's going to have a breakout. So breakout is a good thing, right? So the breakout here at 12 and 1/8, it would be the best time to buy, right? Because at this point, the stock has been down, right? It's here been for a while in the resistance zone. And then here is going to start moving up, right? So this is the best time to buy, right? In the breakout. Now, breakdown is the opposite, right? So stock has been moving up, or maybe it's already in stage 3, right? And at some point it's gonna go below the 30-day moving average, or the 30-day weeks moving average. And this is the time that you want to sell, right? So maybe you held to the stock, has been going up, and then maybe in the last few weeks it's been in that resistance zone, right? But it's gonna start breaking down, and this is the time that you want to sell, right? So remember those two terms, because I'm going to quiz you on it here coming up. So more definitions. A pullback, right? A pullback is basically when the stock, it might drop and then it pulls back. So when it pulls back, the challenging part here is that we don't know if the pullback is going to start picking up again, right? Or if it's going to pull back and then go down again, right? In this case, it went down. In this other case, right, we went through that breakout. We think it's going to go up. Well, that's good. And then there's a pullback. So again, here, we don't know if it's going to move below the 30 weeks moving average or if it's going to keep going up, right? but that's all it means. A trend line here. A trend line is if you see those ragged lines or candlesticks, if there's 3 points or 2 points that we can connect, that creates a trend line, right? So that gives us a little more confidence that the stock is moving in a certain direction, right? Going up or down. And uptrend, downtrend, kind of self-explanatory if we see an uptrend or a downtrend. And the volume here, which you're going to see later, is basically the amount of shares that are being traded, right? So the volume can indicate market strength, right? Rising markets on increasing volume are typically viewed as strong and healthy, right? So right here, this is really good, right? There's a lot more volume of shares being traded. And typically this is a good indicator. Volume is a good indicator too, to kind of show you if a stock is good buying or not, but there's multiple indicators. Speaking of indicators, there's a relative strength indicator. So the RSI provides technical traders with signals about bullish and bear prices, and it is often plotted beneath the graphs of an asset price, right? So if I were to block this, right, and we're only looking at this, so this is a stock chart for Nike, right? So if an asset is above, you're gonna see this numbers here, right? You're gonna see 10, 30, 50, 70, 90, right? Well, the only ones we care about is right here, 30 and 70 here, right? If the RSI is above 70% here, right, then it means that it's overbought. And at this point, investors might start selling. So this is a good indication to start selling, right? And then when the RSI is below 30 here, it means that it's oversold. So if we're just looking at this RSI, this would be a good indication to start buying, right? Because most likely it's going to start going up, right? So this is an indicator that kind of allows us to work with the rest of the chart. And then here's the volume, as you can see. But anyways, that's the RSI indicator, right? Again, it's oversold when it's under 30, and that's a good time to buy. Overbought is good to sell. There's also more additional indicators. Like I said, this is a really old book, but there's also like the petersreport.com. There's other places where you can get more technical indicator lists, right? I'm going to be focusing on the 20-day moving average, the RSI, which is measured by 14 days, and the volume, right? Which is the support and resistance zone. So those are the things that I'm going to be focusing on teaching you here, and the indicator. But there's a lot more indicators. There's a lot of other chart analysts or I should say analysis that provide other indexes, right? And here's some of the resources that I got this and the things that I learned this from. So remember those trend lines, right? Those candlesticks, right? So when you see patterns that are going down, right? So at this point, what I mean by less bullish is that the stock is going below the long-term moving average, right? So now the stock is gonna decline slower, right? And at this point, it might actually start picking up. It's gonna be more bullish when the support line of the 30-week moving average, when the trend line is broken and it starts moving up, then that's going to be the most bullish, right? This is the time that you want to start buying, and because the stock is going to shoot up. The opposite side too, right? If there's a steep advancing trend line and it breaks down through the moving average here, well, at this point, the stock is going to slow down in increasing, right? And it might start going actually down here. And same thing for a bear, right? If it's on that stage 3 or stage 3, and it breaks down the moving average, well, this is when it might start going down, right? Is the more bearish, meaning that it's gonna go down faster. So going back to the Nike stock chart, right? Here's what this all means. You have the relative strength indicator that we touched on, right? If it's over 70, right, it's overbought. This is a good time to sell. Now, The bluish, right? Like I said, that's the 20-day moving average. In the past, we talked about 30-week moving average, which is what Stan Weinstein suggests. I'm using 20-day moving average. This is the current stock price, right? And the red one is the 200-day moving average. Now, granted, these are settings or parameters that you can choose if you go to stockcharts.com. And anyways, yes. So here for Nike, right, we can see that since August, before August, we can see that it spiked up, right, to about 172. It went down all the way to like 146, right? And then it shot back up to 177, etc. Right? This chart is not the easiest because it doesn't follow, sort of a smooth, but as you can see, you can still determine some of the trends, right? Going up and down, right? So, and again, here's some of the volume as well, right? So around late September, you can see there was an increase in trading volume. And sometimes it's good to look at the, what happened during this time, right? Maybe I want to Google Nike September news, right? And maybe there was something, a merger or an acquisition that increased that volume, right? So, but looking at this also, you can get an idea that the RSI sometimes follows the actual stock, right? So this might also be a good indicator as well that, hey, at some point during September 27, early October, it hit bottom, right? This might tell us that, this is a good time to actually buy, right? And if we would have bought here, we would have made a big profit, right? So anyways, this is just a quick example of a Nike stock chart. Like I mentioned, if you go to stockcharts.com or any other one of them, right, you can view this, right? Make sure, my recommendation, because we are using the 20-day moving average, is to set the parameters here. Let me see if I can I'll share my screen here real quick. So I'm pulling up Nike daily, right? First thing I want to do is change the moving average to 200, right? So now here we go. Like I said, this one's real live. Here's our RSI, here's our stock. This is our 20-day moving average, 200 moving average. This is the actual current price, right? And yeah, this is pretty much it. There's other stock charts websites that you can utilize. TradingView is actually quite nice too. Like I said, it's this is really, at this point, it's really how you want to do it, right? But the difference with this one is that I can actually zoom in. So I do prefer TradingView in the sense that it allows you to zoom in a little bit much more, but honestly, that's all preference, right? And then this one, you can also add your 30-day moving average and whatnot. So, all right, just something to keep in mind. That way you're looking at the same thing that I'm looking at. So based on what you learned so far, right? Let's identify the stages of when we can buy and sell, right? So looking at Nike, and like I said, this is not the easiest chart. So if you get this right, I'll be extra proud of you, right? There's a lot of other ones that we can look at that I think follow a much easier approach. Like, well, we'll pull up one later. But anyways, take a look at this. Pause the video if you need to. Go back and review if you need to. Remember, the things that I would point out is, remember the breakout. So remember what the breakout was and also the breakdown, right? So breakout is when the stock is going to cross the 30 moving average going up, right? So maybe it's been stuck, right, in that stage one, and it breaks through and it goes up, and that's bullish, right? That's good. The breakdown is the opposite. Think of the stock being in stage 3 and is going to start crossing that 20-day moving average, and it's going to start dropping, right? So keep that in mind, right? So based on that, this chart, identify when all the stages in this stock chart, 1, and then 2, identify the best times to buy and sell. So pause the video for a second, take a look, and then we'll move on to the actual answers here. All right, so here's the answers, right? So like I said, get used to determining the stages, right? Stage 2 is when there is a increase, right? Stage 3 is when the stock is gonna be, I guess you could say, stagnant, right? And it's gonna be sort of flat for a bit. Now, the point, like I said, the point is the breakdown, right, happens here. So at this point, the stock crosses the 30-day moving average down. So this would be the best time to sell, right? Because if you hold on to it, well, the stock is going to start decreasing because it's moving from stage 3 to stage 4, right? And at this point, that's not good, right? So you held here at 170, close there, right? Maybe you bought down here at 140, right? So you already made $30 profit, and then the stock is it was stagnant, stage 3, moving to stage 4, you sold at 170, right? So you still went home with your $30 of profit, and now it drops, right? Now you wait to hit stage 1, right? We don't know how far it's gonna go down low, right? And it stayed at stage 1 for a little bit, then it started increasing. At some point, it's moving from stage 1 to stage 2, right? So this part right here, the breakout, right, is gonna shoot up, right? So this would be the best time to buy, right? So you buy in stage 2, it keeps going up, and then it hits stage 3 as well, right? So like I said, this Nike one wasn't the easiest example to follow, but you can find any other examples out there that might actually follow a more smoother lines like this one, right? To make it easier to identify. So at this point, at this stage, right, what other areas are there? So at this point, you want to sell here, take your profits and walk away, right? Again, this is not relying on feelings or anything like that or emotions. This is relying on purely technical work here, right? And then sell, drop stage 2. Maybe you want to wait. That's all on you. But at this point, you have an idea on how to read this stock chart and determine when is the best time to buy and when's the best time to sell, right? So here's some of the investing philosophies. Never buy stock without checking the chart, right? So again, remove that emotion away, right? You're a well-experienced investor now. Never buy stocks when there's good news, especially the chart shows a significant advance prior to the news release, right? So like I mentioned, most people are gonna buy here, right? When they start seeing the news, etc. While the smart investors, right? Those people that are manipulating the market, they actually bought down here, right? So that's what I mean by good news. Never buy a stock because it appears cheap after getting crushed. It can be more cheaper. I guess a good example here would be, let's say you start selling here, right? Well, the stock might actually continue going down. Actually, never buy, sorry. If you buy here, you thought, okay, this is the lowest Nike is gonna go. Well, it went down further, right? So you might lose even more. And also never buy a stock in the downtrend chart, like the example I just showed you. Never hold in stock that is downtrend, no matter how low price earning ratio is, right? Again, if something's already going down and you already determined that optimal time to sell, well, sell it. And then wait later to see what actually happened, right? And most importantly, always be consistent, right? Again, even if you get a gut feeling, etc., get rid of that gut feeling. It doesn't apply here. It applies to real life, but not when it comes to investing. So here's the conclusion of our presentation. Again, remember, always diversify, right? Make sure that you're not making mistakes by investing in stocks with superficial knowledge, right? Do your due diligence, right? Don't trade too often, especially if you're just getting started. Always remember that you have short-term and long-term capital gains, right? Stop getting greedy or emotional. Use the technicals, right? Don't invest without a plan. Don't rely on gurus or experts, right? Never attempt to time the market, and then don't pay unnecessary fees, right? So that is the conclusion of this course. Hope you enjoyed. Let me know if you have any questions. Either email me or send me a message via Instagram. And thank you for watching.